Hello, investors. It's Stuart Cruz from Cruz Asset Management, coming to you from our sheltered in place location in Lexington, Virginia, from my remote satellite office on this sturdy dining room table here. And the whole topic of this particular video is the current unemployment rate that just got printed this morning. What you see here is a chart from our friends at YCharts of the unemployment rate. And then here, that's on the top, the unemployment rate. And current unemployment rate is 14.7%. And on the bottom is the S&P 500. And these gray bars represent recessions. And this time frame is from the 1980s, as you can see here, to present day. So over the last 40 years, you've seen unemployment hit 10%, 7%, 6%, another 10% print, and we spiked to 14.7%. There were 20 million jobs lost last month. That's a record by a factor of 10. The next biggest job print loss was 2 million back after World War I. During the financial crisis, the worst monthly job loss was 800,000. So that's over a factor of 25 times the worst month. So we had this in 1 month. The numbers are actually even a little bit worse because there were 20 million jobs lost, but 6.7 million people left the labor force. So those don't even get counted as being unemployed. So this number is actually worse. And what we also notice is that over time, when job losses or unemployment rate spikes, it comes down extremely slowly and gradually over time. This happens every single time. It goes up faster than it comes down. Spikes up, comes down. Spikes up, comes down. Every single time. So here we are, a spike up. We are nowhere remotely done. We're losing millions of jobs a week. Every week, last week it printed 3 million jobs, which was fewer than the 4 million jobs and the 5 million jobs the few weeks before. So even if we bring that down to 2 and 1 million jobs, these are still bigger prints than we've seen in any other month basically ever. So this number will continue to increase. But really what I wanted to highlight is what happens to the stock market when we're in a recession and during these job loss markets. So here we are, 60 or 70 days in. We don't even have a recessionary band on here yet, but we're confident we're in a recession. But going back to the financial crisis, if we look at this recession, job losses zoom up, and the stock market took about 6 quarters or 18 months to fall more than 50% top to bottom. And again here, in the post.com tech wreck, job losses zoom up, and we lose from top to bottom, call it from 2000. Here are the numbers over here if we look at it. From 2000 all the way to 2003, it takes about 3 years for this to unwind. Now keeping in mind, here's the S&P at 3,000, and over here the S&P is showing it around 200, a level of 200 or 300, so it's 1/10. That's why this number doesn't look that big, or it doesn't look like to scale that big of a deal. But really, if we're looking at the peak at these numbers here, you see back in June of 90, we hit 364, and then we fall to 295, and I guess kind of bottom out around 295, 307. So that only takes a few months. But it did take a few months. And even here, we're at the S&P 500 in the 100, so it's 130 at the time. So the scale looks really small. So I took the liberty of blowing this up a little bit. So if we span this chart to this, what we notice is in November of 1980, where the stock market was trading at around 140, and it drops down to 100 roughly. So it's a 40% loss. That took almost 2 years as unemployment rises in this recession. So what do we see now? We see no recession, and we see from February 19th a drop all the way down to March 23rd of about 33%, and then a huge rally off the lows. That rally ends up being about 30% off the lows, which equates to a total stock market loss of 13.69% off the highs. Now, somewhere along there seems to be a disconnect. I just can't imagine that in 30 days we have, and the worst job print ever by a factor of 10, and really by a factor of 25 in recent history, that we are going to be over top to bottom in 32 days. Now, of course, the Fed did print or did inject trillions of dollars of liquidity into the stock market, and that's going to make a difference. But at the end of the day, if people aren't willing to go out to their jobs, if kids are still in school or still not in school and parents have to stay home, or people are working from home, or the economy is not fully opened up yet, I can't see how it would be possible that the earnings would be anywhere near this print in February 19th when PE ratios and numbers were actually starting to get a little frothy. And right now, where we're at, the ratios of the market are more expensive than they've been in the last decade. And so if you believe we're expensive before this fallout, we're even more expensive now with the projections of earnings to do nothing but go down and unemployment to go up. We haven't even printed the recession yet. So am I likely to think things are getting better or worse? Well, somewhat ironically, on CNBC, I hear all the time, now I'm seeing a plethora of analysts come on defending this market rally, saying why it's here to stay and why we're over the worst and why nothing else is going to be a problem. And usually when you start hearing all of these analysts line up on one side, that's usually a time where you take the other side of the bet. There's a joke about economists and analysts, and it says, why did God make economists and analysts? Well, it's to make the weathermen feel better about their predictions, because usually they're so wrong that it's almost a great counter indicator. So all I'm pointing out is we've only been through this for a couple of months, and most of these things take years to unwind. And if we've had the worst job loss print in the history, then I think we are probably going to have a little bit of time to unwind this, especially if unemployment takes a while to unwind. So we just see this disconnect. Like right now, I'm looking at the stock market. It is down. I'm sorry, we had the worst job print ever in history, and it is up 343 points, or a little over like 1.5%. We're seeing an increasingly big disconnect between the news and what we're seeing in the stock market. So as the headlines are coming out horrible, the stock market keeps going up. Another indicator we might want to look to see what's going to give, because something's got to give, is the gold chart. Now here we have a gold chart, and each one of these candlesticks represents a month. So we saw gold going down, and this is back in 13s, and as the market is doing really well after the financial crisis, gold drop, and you can see these channels that gold goes in. I drew this channel here, and it continued to draw down into this channel, and then it broke through some of its resistance. But right now, gold is in an upward trend very, very clearly, and has been for quite some time. And there's only two reasons why people go to gold. They're either afraid the stock market is going to fall, or they're afraid of inflation. Neither one is good. Now, I think gold will continue to trade up. You're in a channel. There's a lot of momentum. You got your MACD is really positive. It does look to be a little bit overbought through here, but at the end of the day, it's still looking pretty solid. So that's an indicator that perhaps the market got a little bit over its skis right now. And I'm just going to switch this to the SPY and just see where we're at. This indicator would suggest that we are, and I'm going to do this a little bit more short term, we're in definitely overbought territory for the stock market. So you might expect another decline. Now, are we going to go back to these lows again that we saw this thing fall off at and come back up here? Does look like we've petered out and we're in kind of a bit of a range here. Are we going to go back and test these lows? I don't know, but with these unemployment numbers are so dramatically bad, and all this runway ahead of us in order to get back to kind of a new normal, and all this drag on the economy, I can't see how we don't have another big down leg at some point. That would be a good time to potentially rebalance. But we're going to continue to look at the data. We'll continue to watch our signals and make moves on our signals, and not necessarily on my opinions or the opinions of the talking heads on CNBC. We'll continue to watch the data. So thank you for listening. This is Cruz Asset Management, and I hope everybody out there has a very safe and happy Mother's Day. Take care.